So you got exam question 1. You should, after you get this paper 1 down, you should really be focused on that. Probably coming by and talking to me about it, making sure you've got everything. So now we're going to talk about exam 1, question 2. This is what we're going to take in class. You'll have 30 minutes to take it, no more time. I'm going to start off with a template for this question. All right. And it's 18 things, maybe 17 minus 19. So when you do the exam 1, question 2, you should have 17, 18, or 19 bullets. If you don't have that many bullets, you've missed something. All right. This is the worst part of the entire class as far as grades. The average grade on everything else is about an 80 to 85. On this, it's like a 50 or a 60. So a lot of students bomb this. I don't know why, because I repeat this over and over again. I think it's a lot of students are so overwhelmed with multiple choice exams, that an exam like this where they have to really know this stuff. It's just they don't know how to prepare for it. So think differently how you prepare for this exam versus other exams. So you're not in that 25. I have students make 0% on this. We'll be doing some team problems on this to practice, and you'll really see we'll probably do at least 2 of them. So before I give you the template, let's talk about what's in there. I'm going to give you a scenario, a forecast. I'll probably steal somebody else's, because otherwise I'm just giving you my same template every single time. That template is going to tell you something that's going to help you know where you want to invest. Do I want stocks? Do I want bonds? Do I want to be long duration? Do I want to be short duration? Do I want high quality? Do I want low quality? So your key components are, first of all, do you want to be in stocks or bonds? That's going to be all about the strength of the economy. Strong economy, you want stocks. Weak economy, you want bonds. On bonds, you're going to be interested in the direction of interest rates. Interest rates rising, you want to shorten duration. Convexity, you want to be looking for something on volatility of interest rates and make it really clear. I can use the word volatility, but I'm talking here volatility of interest rates. If I say I expect stocks to be volatile, that has nothing to do with convexity. Convexity is about volatility of interest rates. So look for that. Something on quality. That's all about the strength of the economy. The economy is going to be strong. You can move down on quality, buy high yield bonds, buy lower rated bonds. If the economy is going to be weak, you want to move up in quality. Taxes. This is the only place munis come in. I'm going to give you two yields, one for corporates and one for munis. You do the tax adjusted yield and you tell me which one you prefer. What I say about inflation, that's where tips may come in. Also gold might come in and commodities come in, but under bonds, tips. So if I say inflation is not an issue, then tips are probably not a bond you want to buy. Structure and non-US, I won't cover at all. I'll leave those out entirely. There's no real way I can give you structure anyway in a scenario like this. And non-US bonds, I just don't want to mess with it. It's just it's not usually part of that. So these are the things on their bonds you're going to talk about. On stocks, it's the beta. On stocks, the first 3, you notice it's all about the strength of the economy. Strong economy, go high beta. Go cyclical stocks. Strong economy, go small cap. Strong economy, go value over growth. All right. Weak economy, do defensive stocks, low beta. Weak economy, do large cap over small cap. Weak economy, do growth over value. All right. So that's pretty straightforward. What I do here is I give you, there's like 4 things that come out of here. I give you different combinations. And you'll see when we do the practice problems how I do that. You've got to comment on them. So make sure in your notes, these 3 things will be 4 things on the exam. You should have 4 bullets on your exam. All right, you'll see when we get in it. On US versus non-US, there's 2 things there we're looking at on developed markets. And first, I just got to tell you, I'll tell you, I think Europe's going to really be weak in this environment, or I think the US is going to be particularly weak versus other countries. I'll tell you something that will help you know where you want to be. And then I'll also tell you about the US currency, the US dollar. And I'll make them consistent. If I say Europe is strong, I'll also say the US dollar is expected to be weak. So you don't have this conflict. So you don't have, wow, Europe economy is being strong, but the the yen, the euro is going to be weak. And you're like, well, which do I go with? I'll make it consistent, even though it's not often consistent. In fact, a lot of times it's the exact opposite. A lot of times a weaker currency actually helps the stock market, but I'll be consistent. So while the US is really going to be struggling versus other countries and US dollar is going to be really weak, well, then you want to do developed market stocks for two reasons: stronger economy, stronger currency. So two things go there. I don't have emerging down here, but emerging markets, it's a gimme, even though a lot of students miss it. I may say, well, emerging countries will be especially hurt by this recession. What does that tell you about emerging market stocks? You want to overallocate or underallocate? Underallocate. It's pretty obvious, right? I just give it to you. All you got to do is remember to talk about emerging stocks, and it's in the list, so you just do it. On alternatives, it kind of depends. Remember, alternatives, real assets, real estate, commodities, timber, they can help you with inflation. So if inflation is a particular issue, you may do that. If your boss is worried about diversification, then you might do that. Or I might just tell you something. I might say, well, with interest rates falling, property prices could really be strong in this environment. That tells you real estate could be a good place to be. Usually there's two things I'm looking for under alternatives, but it all depends on the scenario. Okay. So this is your list. There's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. There's 10, 11, 12, 13, 14, 15, 16, 17, 18. There's 18 things you should have bullets on. All right. And I would do a bullet for each one. Okay. So you know, and then go back and count. And you count and you get 16. What do? You go back and add more. There's one, I think, yeah, this first one, highlight that first one because I'm going to give you a list of asset classes, except for the very first one. I don't list stocks versus bonds. So you just have to know because that's the obvious one. I want to get y'all in the habit of that's just obvious. Someone gives you a scenario, the first thing you say is your stock versus bonds. So your boss says, hey, I think we're going to be going in a recession this next year. First thing you say, yeah, we better reduce our stock allocation. It's just the first thing you'll say. The rest of them are tweaking the details. So I don't even add that to the list because that's just the obvious one to talk about. That's part of your 18. Let's look at some scenarios here. So I give you this scenario. It may not look exactly like this. I've got it highlighted. The highlights are not there, but you might want to bring a highlight pen in. So what are you looking for? You're looking for stuff related to the strength of the economy. You're looking for things related to the direction of interest rates, going up or coming down. You're looking for the volatility of interest rates. You're looking for anything related to the strength of the US dollar, anything on inflation. You're looking for those type of things. So the scenario will line up all of those kind of things, and then that's going to tell you where you want to invest. I believe the looming fiscal cliff. So this was back, we're almost there again. Congress keeps going through this. I don't know why, especially right before an election. It's kind of stupid, but they keep going through this fiscal cliff. We're hitting the debt ceiling. What are we going to do? Republicans have a couple of times said, we'll just shut everything down. They're going to furlough all these government employees. You're going to scare, do you want to scare Social Security recipients to death right before an election? Does that sound like a good election tactic? So we might not pay Social Security, might not have enough money for Medicare, just scare people to death. So that's what we're facing here. And so I believe the looming fiscal cliff and Europe's sovereign debt crisis is going to send US into recession. That's huge right there. That's going to answer 70% of what you need. We're going into recession. What do you think about stocks versus bonds? Bonds. What kind of bonds? High quality or low quality? What are you going to do with high yield bonds? Avoid them or over allocate to them? What are high yield bonds? They're junk bonds. They're very low quality bonds. What are you going to do with high yield bonds? Avoid them. They're going to be crushed. You're probably going to go out of business. So right there, we've got bonds over stocks, treasuries over corporates, no high yield. What are interest rates likely to do in a recession, do you think? Probably fall. We'll see. All right. And Japan will follow suit, and Europe continue to be in recession. So everything's in recession. Economic and corporate earnings growth will be below historical levels. Are those expected by economists, stock analysts? So everything's bad. However, emerging countries should see decent growth. What does that tell you? Overallocate emerging market stocks relative to other stocks. See how easy, that may be the only comment I'll make on emerging markets, but you got to pick it up. As the consumers begin to spend and the companies open up to trade, inflation should remain well contained. There you got inflation. What does it tell you on tips? What if you told your boss, yeah, I think we should be buying some tips here? Your boss can say, what are you talking about? When we buy tips, we're not worried about inflation. And what about gold or real estate or commodities? You don't have an inflation argument for them. We'll have to see if there's anything else there. I expect interest rates to stay in a very tight range. What are they saying about the volatility of interest rates? High volatility or low volatility? Very low volatility, a tight range. Close to today's historical low levels. I think rates will be even less volatile than that price in the bond market. What does that tell you about mortgage-backed securities? It's kind of the hardest part of the whole quiz. You want to buy them, right? You want to sell convexity. Why? Because they offer that higher yield. Because they're worried about what? Volatile interest rates. You get that higher yield for volatile interest rates. And what are interest rates going to be? Nice and stable. Overallocate mortgage backs to get that higher starting yield. With most developed market world debasing currency, I think the US dollar hold up well. So what do you think about Europe versus the US? Would you rather be European stocks or US stocks? Probably US stocks. Everything's going into recession, but US currency is going to be strong. You definitely want to buy Europe stocks. They're going to be going down, plus their currencies are going to be crashing. I'm not concerned about inflation. While many investors are, I'm not sure diversifying in real estate this round makes sense. Well, they just tell you right off the top that they don't want real estate. But real estate underweight, that's pretty obvious. We should continue to seek other ways to increase diversification. How do you do that? There aren't too many other choices. Maybe timber, maybe commodities. I'm not worried about inflation, so that's a little bit of a tough one. But private equity might not be a bad place. And then the only math problem on the first exam, the second exam was almost all math. On this problem, the only math problem is the municipals. Your marginal tax rate's 40%, your effective is 25%. You ignore the effective tax rate because this is a marginal decision. You just completely ignore it. So if you look at it, I give you long-term treasuries. They're not color-coded. Long-term treasuries, high-quality municipal, high-quality corporates, mortgage-backed. I give you these, and these are the bullets you're going to write on the exam. Okay? You don't have to write them. Well, you can put the title, but long-term treasuries. So this one's a little tricky. I say underweight. I would give you full credit if you said overweights. So one thing they didn't tell you here is what interest rates are going to do. They're not going to move up or down. They're just going to stay where they are. In that case, I don't know if I'd want long treasuries, but you can make an argument. This one's a little tricky. On the exam, I won't make it quite so tricky. I say long term's okay because rates are stable because they're not rising. So that's okay. Why aren't they falling in a recession? Because they're already so low. So that was part of the argument. I don't have that problem with y'all's exam because rates are high enough for them to fall in recession, and they probably will fall pretty dramatically in a recession. Why are they underweighting? Because they want the mortgage backs because rates are going to be stable. So mortgage backs and treasuries are two high quality securities. Treasuries do great if rates are falling and volatile. Mortgages do great if rates are stable. Questions on that? That's the hardest part of the entire thing. There's probably at least 70% in here. I have no clue what I just said. And just like, I'll figure it out later. But now's a good time to figure it out. All right. Remember, mortgage backs hate volatility because you're essentially selling a call option on interest rates. If interest rates are stable, you love them. Why? Because you get the extra yield from the negative convexity. You're getting paid to buy something that gives you an extra yield because they're worried about rates being volatile and you don't think they are. Okay. Here we have high quality. Do we like high quality in a recession? That sounds good. They're long-term. That's okay, right? Because rates are not rising. We got municipals versus corporate. The effective tax rate is the municipal yield, 3.8 divided by 1 minus margin tax rate, 633. The corporate bond is 4.9. You don't make any adjustment to the corporate bond because it's already taxable. Which do you prefer between corporates and municipals? This person has a really high tax rate, so they're going to prefer the municipals because they get a much higher yield. You expect a recession, so you want high quality. This is really only three things. So the effective tax yield tells you prefer municipals over corporates. Quality is good because you expect a recession. Expect rates to be stable, so long-term is fine. So those are the three things you talk about. The tax between municipals and corporates, high quality or low quality, and duration. Okay. This is where students lose a lot of points because I'm looking for three things here, and some students give me barely one. So you're losing a lot of points right there. We already talked about mortgage-backed securities. Stocks overall, I should have started with this one, but underweight stocks due to recession. Now look what I give you here, large cap, low beta. So I combine two together. So got large, and they're consistent. Large cap, what do you prefer in recession, large cap or small cap? Between the two, what do you prefer in a recession, high beta or low beta? So you got two things here. Here's where students lose, and I should have put two bullets here, right? It's two things. We prefer the large cap because we expect a recession, and we prefer low beta because we expect a recession. Make it two bullets. Overweight within stocks because they need defensive stocks in recession. So like both the large cap and lower beta, don't do that. Make it two separate bullets. I like the large cap in recession. They do better than small cap. I like low beta in recession because they're going to outperform cyclical stocks. There's two key words in here. Y'all see them in this sentence? Starts with a W, if that helps you. Within stocks, really key. We might actually underweight large cap stocks, but within stocks, we're going to overweight them relative to other stocks. So within stocks is a critical term. You don't need that with small cap because we're going to underweight them. Here I just say US small cap stocks, but I'll usually say US small value stocks. So if I say small cap value stocks, if I say that with recession, you don't want small cap, and a recession, you don't want value stocks because they're lower quality. Okay. Now you can get full credit if you say over here, I prefer large cap over small cap in a recession, then you'll get full credit for the large cap and a small cap because you said them both. All right. So, but I would still put 4 bullets. You should have 2 bullets under the large cap and 2 bullets under the next one, whether it's small cap or mid cap. Questions on this, because a lot of students lose a good 2-3 points just on that one. 3 points out of 18, that's a pretty significant amount. That's already over 10% of the exam. Questions? We're going to be practicing this a lot. So we get it. Developed markets, underweight because of slow economic growth, and the US dollar is going to do well. Emerging, pretty obvious. But again, what words did I add here? Within stocks. You might be under on emerging, but within stocks, they're going to be probably your highest overweight. And then I added some private equities to get some diversification because they're not daily traded, but I don't know if I really believe that answer. So you're getting a little bit of a sense of this for your team question that we'll probably do next Tuesday. I'll give you and come prepared. If I were you, I'd come as if it were the exam. I used to do that at UT Austin. Anytime a review session, I went to review session as if it were the exam. And oh my word, everybody else is there taking notes, and they get home, now they have 2 sets of notes. The notes from the notes and the notes from the exam review. I went in as if it were the exam, and guess what notes I took? The ones that weren't in my notes. I only took notes on the stuff in there. It just saves a lot of time. Otherwise, you end up with 2 notes. So come in for the team. We'll probably do 2 team questions. Come in as if it is the exam. Give yourself some practice so you can come in and be ready for this. So we'll have 2, probably the last 2 exams, last spring and last fall. I'll give you their exact question, exactly how it was worded. I'm just going to print out the exam paper, and that's going to be your question, and your team's going to answer it. And on that one, if I see people on their cell phones and not paying attention, it's like, how could you be wasting this time? Because you're going to have to do this on the exam. You should be fully engaged, especially if you don't have a clue what's going on. You should be really fully engaged. Because it's like, my word, I got to do this in 2 weeks. I don't know what they're doing. So this is a chance for you to ace this. Will it work? Do you think we'll have any low scores in this class, or will everybody in this class ace it? What do y'all think? Who thinks we'll have 100% acing? All right. Who thinks this class will do better than the last class? Few, or we'll see. Obviously, I'm doing something wrong because there's always a good 20-25% that just bomb it. I'm going to say it may be the student's fault. My justification that I didn't completely mess it up is that a good percentage of the students do really well. So when I have a student on my review said no one in class knew what was going on, I can say, well, here's the 20 students that made 100 on that. So obviously they either knew what was going on or they cheated, but someone knew what was going on. So you can't blame it all on me. But not only do you need to get this for the exam, but you need this for life. This is extremely important stuff. They expect you to know this in interviews. So make sure you spend some time learning this. Here's the next one. Let's see. We got a few minutes. Just kind of just, so what are we looking for? Tell me the things you're looking for. You want to know if they're expecting a what? Recession. They want to know if they're expecting what to do what? Interest rates to rise or fall. They want to know if interest rates are going to be volatile. And I usually say more volatile or less volatile than price in the stock in the market. That's really the key. What is the market pricing versus what I expect? I might expect them to be volatile, but not as volatile as expected. So that versus expectation. So that's the third thing. What else might you want to know related to bonds? Are we going to have any, what we're worried about in 2022? Inflation, anything on inflation? You want to look at that. Okay. You want to look for the US dollar, anything on the US dollar. What do they say about emerging market? You know, that's what we're looking for. So this one's just a couple of years ago. We need to position our portfolio. I believe the economic fallout from COVID-19 will be much worse than expected. Is that sounding positive or negative? Pretty negative. Many are assuming there will be a rapid recovery late summer, early fall, but I believe the economic downturn will be much deeper. And I obviously got that really, really wrong. I was wrong for 2021, but right for 2022. So 2 years early, but corporate earnings will fall and stay below for 4 or more quarters. The pent-up demand for consumer never realizes what actually happened. The pent-up demand caused a supply crisis around the world. It's just the opposite. I'm not saying these forecasts are good. I don't know whose forecast this was that I stole, but I'm saying they're good. But your boss says this, so you go with it. Consumers will be wary of spending even if COVID cases drop, given fears about a second wave in the fall. All right. Stocks versus bonds. What do you say? Bonds, what kind of bonds? High quality, low quality? High quality. All right. Europe and Japan will probably do better than the US. That's gimme. As they are much further along handling COVID and their economies should come out stronger and earlier than the US. The US dollar will weaken. All right. What are you going to do with developed market stocks? Over-allocate. Maybe within stocks you say that, but over-allocate. As interest rates in US continue to fall to historically low levels, continue to fall. So what are rates going to do? Fall. They're going to fall and they're going to stay in a very low, and so very little volatility. That one was somewhat true in 2021. Developing emerging countries will fare the worst. Now, this is not developed markets. This is developing. All right, I'll try not to use that term. This is developed markets, Europe and Japan. This is developing. See that ing? Developed markets, developing markets. That's just like emerging. Will fare the worst. What are you going to do with the emerging markets? Avoid them like the plague. No pun intended. Will be inadequate to address COVID and their trade with US. That's almost true for China, right? I almost nailed China there. COVID really crushed China because of the lockdowns, and then it crushed them when they unlocked down. Spreads on bonds will widen dramatically. What kind of bonds you want? High quality, low quality. We see spreads widening. You want high quality bonds, especially for the lowest quality. Corporate balance sheets are highly leveraged. Firms buying by stock and issuing debt. Municipals are facing huge budget deficits. Assume a marginal tax rate of 25%. Ignore the rest of that. All right. Stocks. What are you going to do on US stocks? Give me some that. Well, first, tell me the 2 words. Starts with a W. Within stocks. So within stocks, where are you going to over allocate on the US? Large cap. Large instead of small. Defensives instead of cyclical. Low beta instead of high beta. Growth. First, growth instead of value. Okay, you got those. How many are going to be on their stocks? US stocks. How many bullets? 4 bullets. Well, 2 under large cap, 2 under mid and small cap. So 4 bullets on the US stocks. How many bullets on the developed market stocks? 2. their economies and the US the currency. All right. What about tips here? Didn't say anything about inflation, did they? What would you think here? Does this sound like an inflationary environment? Consumers aren't spending, recession. So I would say probably not a good reason for tips. You look at the tip yield. These are the actual yields. The tip yield was 2 basis points. So you can get inflation and nothing else. Not a good bond there. These are medium quality. Do you want medium quality here? You might not like medium quality. To the extent that you have medium quality, you got to decide between municipals and corporates. They're intermediate term. You might prefer long term. So you can see what you're going to discuss there. How many bullets you're going to have under municipals and corporates? Anybody remember? So 3 there. You're going to talk about medium quality, you prefer high quality. You're talking about intermediate term, you probably prefer long term. And then you're going to make a decision to the extent that you buy these bonds. Do you want municipals or do you want corporates based on the tax rate? Emerging, we already hit that one. Alternatives, are you seeing anything on alternatives here? Gold, maybe. No inflation and a strong US dollar. What does that say on gold? Probably not a strong case for gold. I didn't give you much on alternatives here. So sometimes you have to kind of stretch for something, but think through it. Gold, do you think about gold, weak dollar, inflation, some prices, gold can make some sense. Real estate, you see anything for real estate here? You might argue, well, lower interest rates, maybe, but it'd be a weak argument. I'll give you some credit. Yeah, dollar weakened, okay, from gold, yeah, that's where I might have said it backwards. I was thinking the previous one. So yeah, you see dollar weakening, gold has generally done really well with the weak dollar. So yeah, if you bring gold in alternatives, that would make some sense. Are you getting a sense of it? We've only just started, so we're going to practice more on this, but you're starting to see how this works. All right. All right. So between now and exam, you got to get this list. It's a good list to keep in your mind because it gives you a good sense of what you need to be thinking about. Well, what are the things that you are looking for? Interest rates. Are they going up or down? And what else? Inflation. What else about interest rates? They're going up or down, and volatility. How volatile they're going to be. Inflation. What's the most important one that drives almost everything? Recession or growth. So those are the key. You might look for the US dollar. It's not a massive list. Those are the things you're looking for. Some of them go together. Recessions usually coincide with lower inflation, lower interest rates. You know, obviously recession is going to be wider spreads. So there's things that usually go together. So when you look at this, duration, convexity, quality, taxes, inflation, and structure, those are the things we talk about with bonds. We're going to ignore structure in US versus non-US. So you got duration, convexity, quality, taxes, and inflation. DC, but no, DC without the U of cuts and without the S of cuts. So DC, CTI, that's for bonds. You're going to talk about stocks versus bonds overall, which should be really, really simple. If it's recession, yeah, get out of stocks and buy bonds. Usually buy longer term bonds because interest rates are likely to fall. With stocks, it's all about the economy. So stocks, you only have really one input. Is the economy growing or shrinking? Strong economy, small cap work well, value stocks work well, cyclical stocks work well. In the recession, large cap are going to do better. They may not do well, but they'll do better. Growth stocks will do better. And then I forget what else. Defensive low beta stocks are going to do better. So that's pretty straightforward. For US versus non-US, I'll have to tell you specifically, but then you also look for the US dollar, see what it's doing. And alternatives, it might have something to do with inflation. It couldn't be the US dollar, right? We've been seeing that that especially gold has been a very good diversifier against a weak dollar. So those kind of things you're looking at. When you look at all of them together, it comes up to 18. All right. So this is the list of the 18. You're going to talk about stocks versus bond. I say quality. By quality, I mean, do we have a recession or not? All right. So we're looking at stocks versus bonds. Recession, move the bonds. Strong economy, move the stocks. Treasuries, there's 2 things. Recession, you probably are going to like treasuries. Treasuries did phenomenally well in 2008. 2008 was probably the single biggest year on record in U.S. history, even including the Great Depression, of how much Treasuries outperformed corporate bonds. It was massive. So duration and quality. Duration is the direction of interest rates. Are they rising or falling? If rates are falling, you want longer term. And in quality, if recession, you want high quality Treasuries, with the one exception that mortgage backs are high quality as well. So if you have a choice between Treasuries and mortgage backs, I say, well, recession, but rates are going to be really stable. Mortgage backs are a really pretty good investment in that environment. Tips, it's all about inflation, although tips didn't do well in 2022. They did better than everything else in the bond market, but they didn't save you. They didn't have a positive return. Mortgage backs, think of mortgage backs as probably your safest bet. Think of mortgage backs as a Treasury substitute. You're trying to choose between Treasuries and mortgage backs. The mistake USAA made when I had that big fiasco was they were seeing mortgage backs as a substitute for corporates. That's not the correct thing. Mortgage backs are very high quality, but they're very sensitive to the volatility interest rates. So try to think, do I want Treasuries or I want mortgage backs? Well, how stable are interest rates going to be? Municipals, which where our students lose a lot of points. But just like with Treasuries, you're going to talk about duration and quality. And then you got to do that adjustment for taxes. All right, so there's 1, 2, 3, 4, 5, 8. There's 8 right there just on the first page. On high yield, it's all about quality. That's really part of the quality. High yield, it's very simple. High yield are exactly the same as stocks. Strong economy, high yield do well. Weak economy, high yield do horribly. Think of high yield as a hybrid. They're essentially stock-like and bond-like. So watch that. Some of these bonds really are stocks. You look at them, triple C's, double C rated bond is really more like a stock. Large caps are going to be 2 things, but 2 out of 3. So quality is recession, and then I'll give you something on beta or on style, but all of those have to do recessions. That's the big thing with large cap and small cap or mid cap. It's all about the economy. We like large cap in recessions. We like low beta stocks in recessions. We like growth stocks in recession. All right. So if you have that, the key is that I'm going to give you large cap and one other, small cap or mid cap. Make sure you have 2 bullets on each one of those. That's 4 things. A lot of students barely give me 1 and can really be devastating. And then developed market stocks, I'll say something about their economies relative to the US and then something on the currency. Usually will be consistent. Emerging is usually a gimme. You just got to look for it. And then alternatives, you might look for something on inflation, diversification, or the scenario might actually specifically say something related to that. And then private equity might have to do with quality. Private equity goes in waves and usually corresponds fairly well with the stock market. It's very rare you're going to have a market sell off 20% and private equity is going to do well because they're somewhat stock-like. But they do give you diversification just on the fact they're not priced every single day. All right, so this could give you 17 or 19, depending on how many I count here. I want to get this in perspective, so I'm going to show you the exam from a couple years ago. So this is 2023. This is the year everybody's worried about recessions. I have no idea which outlook I stole for this one. So let's read through it. And if you see something really, really critical, write it down. What are you looking for? Again, one more time, what are you looking for? Inflation, rates, the direction of rates. So looking for things, are rates rising or they're falling? Recession or growth? US dollar. What else on interest rates? You always forget the second one. Volatile interest rates. All right. Inflation. So there's about 5 of them there you need to go with. Be real careful because sometimes I'll say the market's expecting a recovery next year, but I think it's going to be a recession. And some students see recovery and they go, oh, it's a good economy. I've had students get it exactly the opposite. So read what they're saying. Don't look for, I think that's where multiple choice exams are so bad. Students looking for keywords. Don't look at that. Read and see what's there. Actually let it come in and make sure you're understanding what they're saying. All right. Global growth is expected to fall in 2023, but avoid outright recession, what might call soft landing. Is that their projection? It looks like it is. So they're saying soft landing. avoid a recession. So it's a little tricky. It's not a recession, but it's really strong growth, but we'll see. The recent reopening in China is paving the way for better than previous expected growth. That was absolutely wrong, what we found out. What did the reopening of China do? It killed a lot of people with COVID and it just caused all kinds of havoc. But anyway, as far as 2023, that's what the thought was. So China is going to help with higher expected growth. However, recent financial institution risk, like Silicon Valley, have increased market jitters and raised uncertainty. Thus, growth will remain below historical averages. And market stock prices and interest rates will be volatile. All right, so economy, what do you say there? Below average, but not disaster. What about rates? They haven't told us the direction. What have they said? Volatile. What would you expect them to do rates here? Maybe go down. They may kind of just go up and down a bunch. We'll see. What about inflation? Anything there yet? Nothing yet. US dollar? Nothing yet. All right. Inflation globally and in the US will continue to fall and return to 3.5% or lower in the US. So what happens with inflation? Falling. Much lower than price in the bond market. Interest rates will fall as central banks shift from a tightening to an easing stance, needing to respond to the rising financial institution risk. What's interest rates going to do? Volatile. What did they just say? Interest rates are going to do what? Read it again. Interest rates will fall. So does that sound like? All right, read it again. Interest rates will, I'm not going to do what Aaron did last night, but what interest are going to do what? They're going to fall, all right? So that's the key. Falling and volatile. Rising uncertainty will cause corporate bond spreads to widen. That's pretty important to you. That's, if you have spread widening, what does that mean? That means lower quality bonds are going to do much worse than high quality bonds. Spreads widening. Treasuries don't have spreads, so they're not going to be impacted at all. AAA spreads might widen like a basis point or two, but BBB bond spreads may widen 100, 200 basis points. So it's going to be much more impactful on those lower quality bonds. We should be more defensive in our portfolio. That right there is just a gimme. When someone says more defensive, that just automatically tells you bonds instead of stocks. It's just glaring. Large cap instead of small cap. Growth instead of value. All right. It just, when they say more conservative, more defensive, what does it mean on beta? Obviously, defensive stocks. They're in the title. All right. It says especially within our stock portfolio. So that's, you've already got 3 of them right there. That's pretty straightforward. I remain concerned about property types under real estate as there's been some overbuilding and office real estate vacancy rates remain elevated. All right, so there we got something specific on real estate. What are they telling you there? Invest or avoid? Avoid. I was just reading an economist. No, it was some podcast of the overbuilding of apartments in Austin. And what's that doing? So they're actually seeing apartment rates come down in Austin. You still would be shocked at what they are versus San Antonio, but they are coming down. So yeah, there had been some overbuilding, but this is 2024, not 2023, but it was happening in 2023. The US dollar should strengthen. All right, what are you going to dollar? Just yell it out, the obvious. Strengthen. That's y'all's problem, is like it's too obvious. You just want to comment on the hard stuff, but comment on the easy stuff. US dollar will strengthen as investors seek safety in global reserve currency. Europe and Japan will see weaker economic growth. What are we seeing on developed markets? Markets avoid for 2 reasons now, right? Weak. And the key here is not weak. but weaker. Okay. There is a relative here because if US is weak and Europe's weak, you got to know which one's weaker. But here you got a weak dollar, a strong dollar, so weak euro, and you got these markets are weak. And which markets? Well, it's Europe and Japan. That's probably 80–90% of the developed market right there. Japan's a big part of the developed market, and Europe's, a big chunk. So other than Australia, you've essentially got developed markets there. Some major current countries might fall in recession, depending on the Russian Ukraine prices and how COVID plays out in China. Emerging countries might be the one bright spot. So what are you going to say on emerging? So I went on emerging, just say positive or negative. What does this sound here? Positive. So we've got essentially everything, don't we? So that's essentially what you want to do. You might think it in these type of categories, so you have that written down, that becomes obvious. So what are you going to do? Remember on bonds, we have duration, convexity, quality. So on duration, what are you going to do? Lengthen duration or shorten duration? Lengthen. That's 2 points. Right there. I'm going to ask you on treasuries. I'm going to ask you on corporates versus munis. There's 2 points right there. What about convexity? Buy convexity or sell convexity? Rates are going to be more volatile. Buy convexity. What about quality? Do you want to move up in quality or move down in quality? So there's 1 point. And there's 1 point. So there's 5 right there that you have just knowing those 3 things. So if we come down to these long-term treasuries, we said it's treasury versus mortgage backs. Which do you prefer here? Treasuries because of volatile interest rates. So overweight due to long-term as rates are falling and want to lengthen duration. That's a complete answer. There's shorter answers that probably give you full credit, but I would say that I want the overweight. You understand overweight versus underweight, hopefully. I've had students that's like they didn't understand those words. Overweight means you normally have 5% in long-term treasuries. Now you're going to maybe go to 10%. You're going to have a higher allocation. Underweight would mean, oh, sorry. It's a spam call too. I thought I put it on a airplane mode, but I guess not. All right. So, yeah, I lost my train of thought. So, so we like long-term treasuries, rates are falling, and overweight as weak economy, spreads widening, want quality. So you can be very summarizing your answer. You only have 30 minutes for this question, so you have to write quickly. But you want to be succinct, but make sure you cover all the points. You see spreads widening in there. That's a strong indicator you want treasuries. I mean, it's just an obvious thing. But spreads widening, treasuries almost always are outperform corporates. It's just a gimme. All right. Questions on those two? Everybody's understanding where we're going? Y'all promised me you're going to do better than the previous class. So let's see. What about tips? What do we say on inflation? What would you recommend on tips? Overweight or underweight? Underweight, why? Inflation falling. What if you write this? How many points will you get? It's the right answer, but how many points do you get? 0.
Oh, wow.
All right. You tell me underweight. This isn't a true false exam. I don't want you to go in there and guess and you got a 50-50 chance. No, you have to tell me the because. What is more important, the underweight or the because? I think the because is more important because you got to understand what you're looking for. So underweight because inflation is falling, right? Then mortgage backs. What's your recommendation there on mortgage backs? We're going to buy convexity. So what do you want to do? Overweight or underweight? Underweight. Why? Interest rates. Volatile. That because is so critically important. Some students lose a lot of points because they don't tell me why, and the why is so critically important. That's very true in an interview as well. Okay, I think we should underweight mortgage backs right now. You don't get many points for that. You say, hey, interest rates can be pretty volatile as the Fed tries to figure out this next rate cycle. I sure wouldn't be buying mortgage backs right now. I'd be buying convexity right now. I just don't trust, you want a good solid answer. The why and the why are really critical. All right, the next two you're going to do together. So we got a few things going on here. We got medium quality. So corp and munis, you can talk together on them. Medium quality. What do you want to do? Overweight, underweight, medium quality. What do we say about corporate spreads? They're going to widen. So underweight due to widening spreads. So there's the quality, then corp and muni duration. What would you say? What are rates going to do? They're falling. Intermediate is okay, but prefer what? Longer term. So here, underweight. Here I might say slight underweight. And then the last one is the tax equivalent yield. Now, what numbers do we divide by what? The 3.7, right? What do you do with the 5.5? Nothing. So 3.7. What do we do next?
Divide by 1.
All right, yeah, marginal, so 30%. I don't know what that is. I catch row 5. So 529. So here you just say between munis and corporates, which one do you prefer? Prefer corporates given higher yield. How about you can put the number in here, 5.5% versus 5.29%. They might say, well, I thought we were going to underweight. Underweight doesn't mean go to 0. All right, so their median quality, hey, we normally have 50% in this. We're going to cut this back to 45. Their intermediate term, that's okay. That doesn't mean we're going to cut it down even more. But within that 45%, we're going to slant much more to corporates than to municipals because of this adjusted tax yield. All right. This is the tough one. This is where students probably lose their most points between this and the stocks. Y'all comfortable with that? So it's 3 bullets under 2 things. Quality, duration, and you got to do the tax adjustment. All right. High yield, simple one. What do we say on high yield? Overweight, underweight? Underweight as weak economy and spreads widening. You can talk about spreads widening with the corporates, the municipals, and the high yield spreads, especially are going to widen dramatically.
Wait, I thought you wanted high spreads for high yield.
Well, you want them to start with, but you don't want them to start narrow and go wide. Or this is
Okay.
widening, they're getting wider. Yeah, once they widen, what do? Then you buy the high yield. But while they're widening, you don't want them because they're getting worse. All right, so spreads are widening. They're going to go much higher than 7.8 to much higher number. But not only that, in a weak economy, what are high yield really likely to do? Go bankrupt. So you're going to lose almost everything or 60, 70% of your money. When is our exam in here? I can't remember. I remember the date. October
The 22nd.
22nd. Ah, okay. If our guest comes in, what y'all need to do is shame them. So after the exam, I could send the exam question to Capital Group and ask them to answer the exam question. Would you like to see that? Wouldn't that be interesting? They could bring it back. I tried that with USAA and they wouldn't answer it. They refused to answer it. So, but you can, y'all bring it up. If I don't bring it up, I'll feel even more guilt. We'll see. I don't know. Was he texting me that he's on his way? No, not yet. All right. Hopefully he'll come by. We'll see. He might not be able to make it. Huh?
So spreads are widening. Would that mean that the bond is becoming more expensive?
It's becoming cheaper. Its price is falling. So a bond, as your discount rate on bonds increases, the bond price falls. If spreads widening, the discount rate's going wider. Remember in the notes, we talked about that. Boy, I don't know if I can find it. It's going to be way back here. All right, so the risk-free rate falls. Well, let's do this one. Risk-free rate rises and spreads widen. That might not be the best one. Well, this one's going the wrong direction, but the risk-free rate falls. That's good. Interest rates fall, bond prices go up. Spreads narrow. That's like the best scenario. That's when you want to buy the high yield because interest rates are falling and spreads are narrowing. So you get the double benefit. Your discount rate's falling for two reasons. All right, that's an unusual scenario because why are interest rates falling? Usually because of recession. What do spreads normally do in a recession? Usually widen. So that's a fairly unusual scenario. Here, the risk-free rate rises and spreads widen. That's unusual as well because when the interest rates rise, usually in a strong economy, you expect spreads to narrow. So you kind of have two opposing forces. The risk-free rate is falling, but the spreads are widening because of a recession. In that case, the Treasury is going to outperform. So Treasury doesn't have any spread. It's just interest rates are falling. Corporates, you got the risk-free rate coming down, but spreads widening. It depends on which goes more. If the risk-free rate draws 50 basis points, but spreads widen 100 basis points, you're going to lose money on your buying because your discount rate goes up 50 basis points. If the risk-free rate draws 50, but drops 100 basis points, but spreads widen 50, then you make money. But you still make more money on the Treasury because interest rates fell 100. All right, you got to see all those scenarios together. Yeah, you have a question mark on your face still, but
I guess I just don't understand like how, so when rates are changing. And there's like bonds that are already out there, right? People already own them.
right.
Are those rates the same for the bonds that you already, if I already own bonds?
Well, that you're thinking coupon maybe. A bond has a coupon, 6%, but also has a discount rate that discounts those coupons. So you remember in our class last semester, a bond pays 6%, but the discount rate is 4%. That bond's going to pay a price at a premium. If the bond's paying 4% and your discount rate 6%, that bond's going to pay at a discount. So the coupon is the contractual dollar amount you can make, but the discount rate's going to move with the market. Every single day, interest rates move.
Yeah.
So you buy a bond for $1,000, it's going to be worth $1,000 2 weeks from now. Well, if interest rates fall, it might be worth $1,020. If interest rates rise, it might be worth $98. Spreads are part of that discount rate. When spreads widen, what happens to your discount rate? It's going to go up, bond price is going to fall. All right. Now, if you have a recession, two things are happening. The risk-free rate's falling. What are spreads doing? They're widening. Do you make money or lose money? Depends on which force is stronger. Okay, with high yield, what's going on? High yield, remember, they don't care about duration. All they care about is spreads. So you go on a recession, high yield, you just know you're gonna get killed, crushed. All right. AAA bonds, the spreads might widen 5 basis points, but interest rate might fall 50. You'll still do pretty well with AAA bonds. All right, everybody see that? I mean, this is a tough part of, because there's so many moving pieces, but they are correlated. Recessions are usually correlated with spreads. So it's not like it's just some random thing. Right? Large cap and low beta. We have two things here, right? 1, 2. So how many bullets did you have in our large cap? 2 bullets. Well, 4 under stocks, but 2 under large cap, 2 under mid or small cap. So large cap, what do you want to do? Overweight, underweight? Overweight, large cap as preferred over small cap in weak economy. Plus, she actually said, and she said, be defensive, right? She just gave it to us. And then overweight, what's the second one? Low beta as preferred. High beta in weak economy. And she said be defensive. So she kind of just gave it away there. Right. So 2 things. Make sure you see 2 things. I say that like 40 times between an exam, and still 34% of class and previous classes get maybe 1 point on this. Now, if you say this, you get the point here, but you also get the point on small cap. So if you say over cap, weight, large cap as preferred over small cap, you've got them both. Okay. But to be careful, you can say underweight, small cap as preferred over large cap and weak economy. And then value stocks. What are you going to do in value stocks? I don't know how to spell underweight. Weight. All right. What do you do on the value stocks in our weak economy? Underweight. Now, if you want to add in the following rates, that is true. It's underperformed. Boy. So I don't really look for the following rates, but you can put that in there. But the weak economy value stocks, remember, they're low quality companies. They're cheap stocks because they're struggled with something. So they generally don't do well in a weak economy, but they do tend to do better in rising rates because so much of their value is in near term. Right. So 4 things on their stocks. How many things are going to have on our developed markets? You may remember. 1, 2, 3, 6, 12. What do y'all see up here that affect developed markets? Developed markets probably does. What else do you see? US dollar. So 2 things you want to say on developed markets. What do we say on developed markets? They're going to be weaker and the dollar is going to strengthen. So you have 2 bullets to say, talk about there. So underweight as economies will be weaker and US underweight with strengthening US dollar. All right, so you have 2 things there. Sorry, Floyd. That's 3 spam calls in 30 minutes. Okay, let me put my phone on airplane mode. Y'all know what song my phone is playing, anybody? Know what the composer is? What does it sound like? 18th century famous composer. J.S. Bach. Yeah. All right. Okay. We won't do any music classes in here. All right. Emerging markets. What do we say on those? Overweight, underweight?
Overweight.
Overweight. Overweight. There's not much to say here other than just repeat what she says. You can almost just copy what she says. Emerging is going to, you can just say as they will be one bright spot world economy, something like that. Just whatever she says. Trust.
Does currency strength have anything to do with emerging stocks?
With what?
Emerging stocks?
It does, but I'm wanting you to ignore it. It gets really, really complicated. There are a lot of emerging companies actually, countries actually peg their currency to the dollar. So it becomes a little challenging. And they're so much more volatile than developed markets that the currency is not as big of a factor as it is for developed. So yeah, I think when I saw the investment society, when I looked at the daily volatility, daily volatility, developed stocks are less volatile than US market. And that's probably because currencies are helping diversify those returns a little bit. You don't notice that with emerging because they're just so much more volatile. You're almost not going to notice the currencies. All right. And what do we see on alternatives? So weak economy, you could make an argument. It wouldn't be a bad argument to say, there's a lot of economies that are production products like steel and silver. And so, they're not going to do well in a weak economy. You could say that. Strong US dollar, does that tell you anything about an alternative?
Gold won't be good.
Yeah, you could say avoid, so that would give you a point. Underweight gold with strong US dollar. So falling rates is good for gold. So gold gets a little confusing, right? Gold likes a weak dollar. A weak dollar are falling interest rates. Here you have falling interest rates, but you also have a strong dollar. So, but if you said that first part, I'd give you full credit. If you forgot to talk about falling rates, it can be tricky which direction go. And then she gave us one more definitive thing. What did she say? Which of these is an alternative? Real estate. Underweight. Real estate with overbuilding. Now there's one we haven't done yet. So what's the one we want to finish with? Stocks versus bonds. It's not on the list. So what do? We overweight, underweight what? Underweight what? Underweight stocks, overweight bonds, especially their quality bonds. So there's your 18 things. All right. This is the exact piece of paper I handed out to the class.
Can you be giving us the list except for stock?
Yeah, this that I just showed y'all is the exact exam, except for the yellow stuff. And this up here. All right, what I first loaded up is the actual exam. So you get this without the answer. I don't give you the answers, but you get that without the answers. All right, so I'll give you the scenario. You get this scenario all the way down to here, and then I give you the asset classes, and you write the bullets underneath the asset classes. All right, is it getting clear? 30 minutes though, you got to move fast. We'll have class right afterwards, so you don't leave, but we'll have class right afterwards. All right, I love this question. I think it really forces you to bring it all together. The nice thing about this question, you don't have to learn anything different for this question than you did for the first question. This is the applied part of it. Can you logically think through what you would do? You might get a scenario like this in an interview, and you need to be able to think fast. So you got to get to the point where it's just like, it's just automatic. You hear recession's coming. Wow, okay, we're gonna move up in quality, avoid stocks. We're probably going to lengthen duration. We'll see how volatile interest rates are. We might do a play on mortgage backs. You're just automatically start thinking where you're going to put your money. Now, there are caveats to all that. So I gave you the GMO argument. So GMO is arguing you should buy value stocks. And they say that's even if we have a recession, and that's even if interest rates fall. Why do they make that argument? Because they think growth stocks are grossly overvalued and value stocks are very cheap. But they even admit they're going against the grain. They're going against convention. So there's convention, which is what we're learning here, but then there's valuation. It's possible you avoid something because it's just really, really expensive, no matter what you think interest rates are going to do. So if you think we're having a really great economy, but spreads are incredibly narrow right now, you might say, well, you know what? high yield's only paying me 300 basis point spread. That's a horrible spread. Even if we have a great economy, they can't really narrow much more. So those are those kind of things. I'm not going to do that on this exam. This exam is going to be very conventional. What's the traditional approach? But you do realize valuation comes in. So that's the trick with a question in an interview is there wants you to do all this conventional stuff, but then you got to throw valuation and on top of it. So you might say, well, I expect a weak economy next year. Rates are going to be falling. Boy, that's usually a time you want to go on the growth stocks. But boy, I think growth stocks are so expensive right now. I don't think that would be such an incredibly intelligent answer in an interview. They'd probably hire you on the spot. And I've had some students get hired on the spot because they just gave such a great answer. That would be a really, really strong answer to be able to give. So, all right, Luke.
So exam one is just gonna be 2 questions, the one we submit and this one?
Yeah, the one you've already written and you're drafting, right? You're getting it perfect, and especially after the first paper. And then you'll walk in, and this one you'll do on hand writing. I'll give you the one paper with the question, and you'll blank piece of paper, and you just write it. And you'll have 30 minutes on that one, then we'll just have regular class afterwards.
Okay.
Other questions on the first exam? The first question you submit on Canvas as an essay. Some were asking about format. I don't care about format. Some use the same format as paper one, but you don't have to. You can write it however you want to. I hate double space. If you give me double space, I'll probably change it to single space. It doesn't have to be 2 column or anything like that. I showed you several student examples before of the first question. I don't think I can't show you examples of the second question because it was on paper, and I don't keep exams that long. So hopefully getting more comfortable with it. I'm mainly worried that you understand all of this. This seems so easy to me because I've been doing this for 30 years, but it's probably not quite there yet. So how do you get something like this to go permanent? It's quizzing, it's spacing, it's writing. Those are the 3 things that and this needs to be in your permanent memory. So you should just make the quiz out of this and then quiz yourself, quiz each other, but write it out your answer and just do it after 1 day, then skip and do it after 2 days, and then skip, do it after 3 days, and then do it after 2 days. So somehow that puts it in your permanent memory. You need to put in your permanent memory, not for the exam, but for, your career. This is what you do. Even if you don't work in this area, you're going to get your 401k plan when you start your career, and you're going to need to ask, what do I do? Do I buy stocks? Do I buy large cap at USAA? I took over USA's 401k plan. It had 3 options. By the time I was done with it, it had 13 options. Guess what we added? We added growth, we added value, we added large cap, we added small cap, we've added developed markets, we added emerging markets. We added all these asset classes so that people could make those type of choices. We didn't do cyclical and defensive. We didn't do high beta, low beta. But we added all those so that people can make that decision on their investments, how they want to move their model around. Before that, all we had was stocks and bonds, just all stocks, all bonds, and we had one weird option. All right. So start working on it, especially after you get paper 1, turned in this Friday, start working really diligently, get exam question 1 out of the way, and then start working on these. We'll do a team question maybe Tuesday and Thursday, where I'll give you the last 2 exams and I'll just print them out, and you'll have those 2 exams, and you as a team. So we'll spend more time on the team question than normal. So I'll give you essentially the same amount of time you'll have in class. So we may be taking a full 30 minutes on 2 team questions, but it's incredibly valuable. Those are 2 team questions. I see students on their cell phones are really upset, because usually the students on their cell phones don't know what's going on, and so they're just ignoring the whole thing and thinking I'll learn it later, and just seems like an incredible waste of time. This is a perfect opportunity for them to sit down and learn it from their peers. And some students like, no, I'd much rather check if I got a like on my last Facebook post. It's like, which of those is going to be more important 5 years from now, do you think? Knowing your career or knowing your Facebook likes? My guess, you probably know the answer to that. So be engaged, start learning this stuff. What should you do for next Tuesday's team question is study for the team question as if you're studying for the exam. Remember spacing and quizzing yourself. The next two team questions are perfect spacing and quizzing yourself so you can really see. And how many bullets you're going to have in your answer? At least 18, somewhere around 18. All right, you see where they are. How many will you have under munis and corporates? 4. No, munis and corporates. 3 on the large cap. 2. All right. So you're starting to get on the developed markets. 2. All right. You're starting to get it. All right. If I offered the $10,000 again, can anybody get it? You could now. All right. Too bad. You should have got it earlier. I probably could give away 10,000 right now because the market's up so much. I was looking at my mom's portfolio. She has like a $400,000 portfolio, and we're sending her $6,000 a month to pay for her assisted living, and it's the same 400,000 a day as it was 2 years ago. So essentially, the stock market has made us $6,000 a month for the last 2 years. I was telling my brother, yeah, her portfolio has not moved in 2 years, even though we've sent what is 24 times $6,000. We've sent all this money, and her portfolio is up dramatically. So she's lucky she's got a finance person as her. Guess how much I charge her to manage her portfolio? 0. So it's free, completely free. All right. So here's another scenario. I'm just showing the highlight on it. I believe the recent good economic data is genuine. I expect surprises on the positive side. Higher economic growth. Interest rates should rise. That's important. Emerging countries should see very strong growth, while developed countries, especially Europe, should be very weak growth. The US dollar should strengthen. We need some added diversification, whatever that means. That might be commodities, private equity. This one doesn't say anything about inflation. So if I don't say anything about inflation, it's maybe implied. I'll be careful to put something in there on all of those. So I don't know what this is. What is that? So move down in quality, shorten duration. You prefer US and emerging over developed. So there's your solution. I think we did this one last time. No, we did that one there. Oh, I can't remember. They looked like the same ones, but I can't tell. So you're seeing a pattern here. All right. So I don't want to beat it to death. But again, you set up all the data. You can bring in a highlighter if you want to, but I'd recommend you think something along this, making a list of what you're looking for first. So you have that in your mind so you're clear, and read real carefully. So are they saying they expect a recession? Or are they saying everybody expects a recession, but I don't? Just read it real carefully. Don't just see a word and like multiple choice, just think, oh, I see the keyword, I got to go with that. Read it in depth and make sure you have it. I try to make them worded clearly. I've had some in the past where I pick a word and I discover that was really bad wording. It made it confusing, and so I'd have to kind of pull back on that. Now, some students ask, this is a scenario written about today's market. What if I disagree with it? Well, what if you disagree with your first boss? What are you going to do? You can try to convince them. What if you don't convince them? What do? You do what they say. Our CEO at UTSA, boy, I disagreed with him a lot. And guess what I did? Once he said, do this, I went and did it. I might have been grumbling the whole way back to my desk, but I just did it. I remember in one meeting, I had like 7 things to propose, and he said no on the first 6. I go, well, I got one more, but I don't know if I should show. He goes, why? Go and send it. I'll listen to it. It's like, and he said yes on the 7th one. But yeah, you ask, you try to convince. So you have a responsibility to say, if you see something, say, I read this in an article or someone was saying this, you have that responsibility to try to convince them. At USAA, we had interns. I took them to meetings with the CEO as they had a fun time, but I took them to our asset strategy meeting. I said, the CEO, don't say anything, just sit there and listen. But in our strategy meeting, they could talk all they wanted to, unless they became a pest, overdid it. Some interns get a little too talkative where they dominate the meeting. But I say, hey, put your opinion out there. You're a member of this team. And the other, you have to be careful. You say your opinion in that group, they're going to let you have it. If they disagree with you, it's not that they hate you, think you're stupid. That's the way that group was. We're brutally honest with each other. So you just got to start doing that. I'd recommend you start doing this yourself. What is your view of markets? What's expensive? What's cheap? What do you think the Fed's going to do? What is our economy going to do? Where would you invest it? So if you get that as a question in an interview, you know what you're going to say. And the key is not that you're right. The key is that you understand, you have an opinion. What if you can't do that? Then go out and steal somebody's. Go read someone else's opinion and reword it to make it your own. So you're ready with an interview question to say what's going on. That's why we do the dashboard teams, because you know what the Fed's doing, you know what markets are doing, you know what interest rates are doing. You're ready to talk about the current environment. So it just gets you really, really prepared. So don't stop with this exam question. Make this a part of your daily routine of watching, give your own opinion. I mean, right now, would you rather be buying developed markets or US? So what would your argument against US stocks? Probably your number one argument on US stocks.
Too expensive.
Too expensive. Yeah, they're much more expensive than developed markets. What would be your number one argument against developed markets? They've been cheap forever. There's no growth there. They're horribly, terribly to run countries. They don't, their labor laws prevent, there's all these kind of arguments. Those are all great arguments, but what do you believe? And so right now, the key is that you just believe something and go with it, have a strong argument. You're not trying to be right. You're just trying to have an opinion so you can start debate it and challenge it. I took a composing class at UT Austin, and we had one professor. I love this professor. He's still my favorite professor I've ever had. He made us write a piece of music like every 2 weeks. And he said, you just keep writing, because 10 years from now, you're going to hate everything you've written in this class. But you just got to get out there and start practicing. You start applying what you're doing in finance. You're all juniors now, right? So you should, or juniors and seniors, you should start doing stuff outside of class. That's a finance person kind of thing. So this is a perfect example of the kind of thing you should be doing. And then one good way you can now start, and we talked about this before, in pursuit, sorry. In pursuit of perfect portfolio, Dr. Lowe here. Who's he interviewing right here? They recognize him? Jack Bogle. He started what? Vanguard. Who's he interviewing here? Robert Schiller. Who's this guy right here? Markowitz. What did he invent? Distant Frontier. He passed away last year, sadly. Who's he interviewing here? I've heard of Fama French. There's Eugene Fama. He's still alive. It's hard to tell, but yeah, he's still alive. Merton. You've heard of Merton Miller. There's good old Robert Merton. Jeremy Siegel. If you want a strategy, go find Jeremy Siegel. He's extremely bullish on stocks. He always has been. He has his opinion, and he'll put that out there. There's Charles Ellis, another famous person. He hates our industry. He thinks we overcharge. We have too many complicated products. Mark Scholes. Have you ever heard of Scholes? Black-Scholes formula, the option pricing model. There he is. You see why this is such a wonderful, wonderful thing. William Sharp, you've heard of William Sharp. We talked about his article here recently, a Nobel Prize winner. So yeah, these are Leibowitz, my word, these are famous. And Dr. Lowe himself, he's no lightweight. He's the one interviewing them, but he's no lightweight himself. MIT professor, he's written books that I highly recommend. So I would be, at this point in the class, I'd be listening to one of these Pursuit of Perfect Portfolio, one a week. And just let your mind kind of take what we talk about in class and combine it in here. You'll be hearing a lot of overlapping items. But these are the greats of our profession. Or change majors, one or the other. Right? If you're so bored already, I see students seem so bored. It's like, you're going to do this the next 50 years of your life. Are you kidding me? So, if you really find this boring, you're probably going to have to go on the corporate side, which is fine. I started on the corporate side. But this is the investment side. You're just in the markets, you're into the Fed, you're in the economy, you're into individual stocks, you read articles. This is the investment side. Remember that group I told about? We had dinner and all of us are just talking, we're talking shop. If we all went out and played soccer or whatever, we'd be yelling at each other about the Fed while we're running up and down the court. I mean, it's just all we do. So this is your life, and it's a great life if you really, really get into it. All right, let's start a little bit on execution. I guess our guest isn't coming today. I don't think he texted me. I do have a text, but it's not from him, so he must have gotten lost there. All right, so we talked about this earlier on execution. Are you going to do it yourself or hire a manager? That's two very separate things. If you're gonna do it yourself, what do you need? What do you got to set up? Your brokerage. Which broker are you gonna hire? Some of y'all may have Robinhood. Who's the customer of Robinhood? Well, everything's free for you, so you're the product, you're not the customer. So your trades is what Robinhood's selling to everybody else, but that's fine. It's nice to have free. Schwab. That's where I am. I could even log in and show you my portfolio, but I'm not going to. I could show you my mom's portfolio, but I'm not going to.
Show us the secrets.
So Charles Schwab. I could say TD Ameritrade, but didn't Schwab just buy them? So you're kind of running out of options. I love Schwab. I like it. I got like 60-70% of my money there. So they love me. So they take really good care of me. The nice thing they've let me do is manage some of my charities on their site. Even though these charities only have like 100-200,000 bucks, they let me manage the money there because I have other money. So I like them. They're treating me really, really well. Which one do you use? You have to be careful. So Robinhood and Schwab, everything's essentially free. So that's good. I had one charity I was working with. We were going to hire Frost because Frost was their bank, and Frost is a wonderful bank. And they sent me their fee schedule, and I just about passed out. It's like, this is a fee schedule from the 70s. I can't believe you still charge this much for trades. It was ridiculous, ridiculous. Frost should not have any brokerage customers at all. They shouldn't have one. They should have 0 customers. It was just shocking. Why? Because that's just not their thing. That's not what they do. I tried using Wells Fargo once because I had another charity and we used Wells Fargo. One guy quit after interacting with me because they messed up so badly. He was so embarrassed by how horribly they did that he just quit. I wrote letters to the board of directors because they were so horribly bad. Sounds like Wells Fargo, right? They do well for us as a banker. The brokerage side, it was I could tell that horror story. It got comical if it wasn't so ridiculously stupid. At one point, they called me and say, "You're allowed to do this trade." So I did the trade. It was an option trade. And then he called me 30 minutes later and said, "You're not allowed to do those trades." It's like, well, okay, you're 29 minutes and 59 seconds too late because I did the trade the second you told me I could do it. So I fired them and went to somebody else. So there is a difference. Not all brokers are the same, but start with the fee schedules. You should have commission-free trades now. Absolutely, wherever you go. Options will cost you a little bit, but you're talking pennies, like 10 cents or whatever. It's really, really cheap. So brokers, so if you can do it yourself, you're going to hire a broker. You should go ahead and hire a broker now, even if you don't have any money, and see if they have a paper portfolio. If you can't do that, Bloomberg has a pretty good portfolio function where you could set up a portfolio in Bloomberg and pretend like you're trading stocks. So, and that gives you 2 benefits. One, it gives you in the habit of buying and selling stocks and building a portfolio, losing money, making bad trades, making good trades. But it also helps you learn Bloomberg's portfolio function, which is a really good function. So that's really good. They do all the attribution. So you can see why you outperform. Was because you bought too many tech stocks or whatever. So all you have to do in Bloomberg is just hit the port button and it'll show you how to do it. So start doing a broker now. If you don't have a broker, start a broker now and do it. Best yet, at Thanksgiving, say, "Wow, I really need to start a brokerage account, but Uncle Ted, I don't have any money. I wish a rich uncle would give me some money so I could start a brokerage, or maybe give me some of their money that I could just, I mean, you're worth 10 million bucks. Give me 50 million. Give me $50,000. Let me just play with it. So I'm a finance major. It's just consider it part of my education." Do you have any uncles like that? Or aunts that have just money sitting around? So, I mean, try it, bring it up, talk to your mom or dad beforehand. I got to get Uncle Ted to give me this money. So y'all bring it up and we'll do it like this. I mean, that's not a bad way to have someone just say, "I'll manage money for you. I might lose the money. I'm brand new, but it's 50,000 out of your 10 million bucks. Why not?" All right. So get some practice, start doing that. Versus manager selection. You're going to hire someone to do this for you. That's going to either be a mutual fund or exchange traded fund. If you do an exchange traded fund, guess what you have to set up? A broker. So you're back to that broker anyway. If you buy a mutual fund, you can buy the mutual fund directly from the mutual fund company. So you don't need a brokerage account to do that, but get a brokerage account. All right. Are you going to be active or passive? We'll talk about that. If you're active, you're going to try to beat the market, which is going to cost you more. You can do that at the asset class level, where you're going to try to buy more small cap or large cap or whatever, non-US stocks, or I can do it at the security level. I'm going to buy more of Apple, buy more of Google, or Alphabet. Are you going to be passive? That's good old Jack Bogle from Vanguard. You just buy the market. And the key there is you save on fees. We're talking about saving not 10%, 12% on fees. It's like saving 98, 99% on fees. It's much, much, much cheaper, which gives you a head start when that you can do with mutual funds, that you can do with ETFs, that you can do with options and futures. There's a lot of ways to buy the market very inexpensively. All right, so we'll talk about that more. Talk about the efficient market hypothesis. So this is something I learned. So it was interesting. The president of our investment company came out to office and he said, "Ron, Stewart's retiring." I'd worked for Stewart for a few years. "Stewart's retiring. We're hiring his replacement. We want you to interview this guy. He's in place." I said, "Okay, it's fine. I'll interview him." And he said, "Oh, by the way, we're looking at you for the job as well." I thought, you want me to interview this person and you're looking at me. So I'll give you a really bad review of this guy you're wanting me to interview. But they ended up hiring both of us. He hired me as the head of equities, and this guy they thought he was too young, that he was good to come in. And he was kind of upset that he was working for me because he thought he was my head of equity until he came to USA and discovered he was really lucky I was there because I knew the ropes of the CEO and all that. So he was kind of happy. And then I retired 2 years later. So he kind of worked out really well for him. But when I came over to equities, one thing I noticed was we ranked all of our funds against all of our competition. And on the equity side, we'd rank in the top 4 or 5. We were never number 1, but we'd be 3, 4, or 5, kind of in that range. And one firm was always number 1. And what firm was that? Every single time, number 1. Any guesses? I've mentioned the founder of that firm before. Vanguard, number 1, number 1, number 1. I go, so Michael worked for me, great guy. Man, just did the work of like 6 people. It's pretty amazing. But I go, okay, Michael, the only reason Vanguard's in first place is because they do index funds, and their index funds are cheap. I want to look at all the equity funds without the index funds. So he ran it, got a new list. So now who's number 1, do you think? Any guesses? Vanguard. I probably told you all this before. I mean, it's pretty amazing. I was like, wait, there's no way Vanguard is number 1. So I went out and did a study. What is it about Vanguard that is so different than everybody else? The number 1 thing was pretty obvious: management fees. If you have 4 mutual funds and you can't figure out which one to buy the one with the cheapest fee. That's so easy, because that just gives you an advantage. There is no correlation between fees and performance before fees. So the funds that charge more don't charge more because they're better. They just charge more. So if it's a toss-up, lower fees, just go with it. The second thing is turnover. How often do they trade? The more firms trade, the higher the trading they do, the lower their performance is. Very consistent. These first 2, I take it to the Fidelity Contra Fund. Yeah, they have changed it. Profile, maybe we'll see. Right. So what are their fees? Their fees are what? Tell me that in basis points. 39 bips. All right. So we talk fees and bips. What is the competition charge? 99 bips. Okay. So Contra Fund charges 39. That's pretty inexpensive. That's not an expensive fund. Not too bad. What is their turnover? 16%. That's a pretty low turnover. I had a mutual fund I managed that I hated. I hated this fund. And my boss said, hey, if you're the portfolio manager, you better have your money in the fund. So I put like 10,000 in just to say I had money in it because I hated this fund. The turnover was like 300%. It's crazy, horrible fund. I don't even know if it's still around. It was a terrible fund. So turnover. So those 2 are easy. If we do a Vanguard fund, I don't know if we can get it. Let's try VOO. What are their fees? 3 bips. What was Contra Fund? 39. Who's cheaper? Vanguard, pretty obvious. What's the turnover? 2%. What was contra fund? 16%. So just based on that, you have a huge advantage buying the Vanguard unless you're really comfortable that the contra fund is going to add extra return. It's a $1.24 trillion fund. That's a pretty big fund. I mean, Vanguard's what, a $9 trillion company? So a big percentage. Vanguard does something the others don't that is really unique. Most companies like BlackRock, when they do an exchange traded fund, which we're going to talk about, they create it from scratch and they have to add money to it. Vanguard is so smart. What they did is when you buy their ETFs, you're actually buying a share of their existing mutual funds. So they don't have to set anything new up. It's incredibly and brilliant what they did. And I don't know if they patented that or not, but it's really brilliant. All right, those first two are the easiest ones to look at. After you get past that, it gets tougher. This next one is gains versus losses. So what we know about small retail investors is they do really badly because when they buy a stock, it goes up, they sell it too fast. And if it falls, they hold on to it too long. So retail investors have really small realized gains because they buy a stock, it goes up 10%, they sell. Then they buy another stock, it falls 10%. They say, you know what? If it gets back to what I bought it at, I'm going to sell it. Then it falls 20%. Say, you know what? If it gets back to where I got it, I'm going to sell it. Then it falls another 20%. And finally, what I do, they finally sell it at the bottom. Well, guess what? Professional managers do the exact same thing. If you compare the percentage gains versus percentage losses, the firms that are skewed more or balanced between gains and losses do a lot better than those that are skewed toward the losses. Because it's that ego thing. We don't like to sell a stock at a loss and admit we made a mistake. And so we tend to just, our egos hang on to. This is a very, very difficult number to get. Someone did a study several years ago. It was a really difficult study to do and discovered there's a strong correlation here. Other things that you find, this comes from Jack Bogle's Count on It book, but we discovered these as well. It's very, very true. And then a couple of things I discovered: reversion to the mean. Firms, funds, mutual funds that have done really well last 3 years are likely to underperform going forward. And the ones that have underperformed are likely to outperform going forward. So what's outperformed the last 3 years? Anything holding the Magnificent Seven outperformed. It was a piece of cake. Because those stocks are what driven the markets up. What if those 7 stocks underperform? You're going to want the funds that didn't have those stocks. So there's going to be that kind of revert back. And this is the one thing I discovered was manager longevity. This was absolutely true with Vanguard. One thing I know with Vanguard more that no other firm had was if a fund manager had 4, 5, 6 quarters of bad performance, Vanguard didn't fire them. Because they said, this is a smart person, they get a good process, their long-term record's good, we're going to stick with them. Everybody else fired. Why? Because what Jack Bogle says, we're no longer investors, we're marketers. We market our funds. It's hard to market a fund that's had bad performance. It's a lot easier to say, we replaced that guy and we got a new person. So true. I told my new boss this. He says, wow, that's really interesting, Ron. I'm curious, when are you going to fire XYZ firm? Because they've had 2 bad quarters. It's like, did you just hear what I just said? So, and we drug our feet. We didn't fire that manager. Because we thought they were pretty good, but every time, all the sales people in the halls, are you going to fire that fund? They've had 2 quarters. We didn't fire them. They ended up being our #1 manager that year. It's like 2 bad quarters. It gave me a break. We're not going to fire them for 2 bad quarters. The greatest managers out there have 6, 7, 8 bad quarters. So this is part of it. You hire someone, you hire them not because of their performance. You hire them because they're intelligent. They have good process. They have good discipline. You believe what they're saying. You hear what they're saying, you say, you know, if I had your resources, I'd be doing exactly what you're doing. Hire that person. That's what you're looking for. And then give them 5 years to prove themselves because strategies go in cycles. You know, in 1999, people were firing. I remember the lady in my church, she said, I can't get my broker to buy tech stocks in 99. I was like, you realize those are grossly overpriced. She thought I was an idiot. But yeah, she was going to sell her value stocks and buy growth stocks at the top of the market. Would have been a disaster. That's what most people do. They chase performance. Don't chase performance. Go after intelligence, process, discipline. You're looking for people that they say, I hear what you're saying. That makes perfect sense to me. Let's do that. Now, they better have a good long-term record, but the recent short-term, you almost want them to have done badly last 3 years, especially right now. We're all about the Magnificent Seven. That's why I'm kind of big on small cap value. They just have not done well the last 3 years. They hit their last record back in 2020 or so. So, I'm kind of reversion to the mean. This is how you might think about picking your mutual fund. So line them up on these. The first two are easy. The other ones, kind of think about it. What have they done here recently? You look and say, well, my word, they had Apple and Microsoft and Nvidia. So obviously they did well. But did they have those stocks because they're really good stock pickers, or are they just lucky to have those? Are they going to still have those stocks when those 3 stocks sell off? Those are kind of questions you ask. So what you want to know is not that they have Nvidia. You want to know, why did they buy Nvidia? And what are they going to do with Nvidia now? Okay, so there's luck and there's skill. How do you know the difference? You don't. You'll figure out in about 70 years, which it was, but you're not going to know in 3 quarters. So, all right, we'll stop it there.